So what is compound finance? Compound finance is a lending protocol which runs on the Ethereum blockchain. It allows people to lend and borrow popular cryptocurrencies like Ether. The great thing about it, it's frictionless, it's much more efficient and more decentralized than current financial money markets. Compound currently falls in the middle of the centralized, decentralized spectrum thanks in large part to its open source smart contracts. However, there are plans for future implementation of a DAO, decentralized autonomous organization, and this should allow for markets and interest rates to be governed by community members rather than current structure where all proposals are made by Compound. People that want to borrow digital assets can do that directly with the protocol. They don't need to negotiate anything with a counterparty. However, they do need to add cryptocurrency as a collateral before they are allowed to borrow. The beauty of this platform is that all you need to participate is a cryptocurrency wallet like the Trust wallet, which is a mobile wallet, or a hardware wallet like the Ledger Nano X or Ledger Nano S. And this allows you to log into the Compound Finance dApp without having to create a new account. Your wallet is automatically your account and password, and this makes everything a lot easier. Supplying tokens. When a user supplies a token, it isn't directly lent to someone else. All the lent funds get added to the supply pool, and this results in a much higher level of liquidity. This lending mechanism allows users to withdraw their tokens at any time, as long as there's enough liquidity in the pool. Borrowing tokens. On Compound Finance, users can borrow directly through the Compound Finance protocol by specifying which asset they would like to borrow, and this asset comes directly from that asset's liquidity pool. And this liquidity pool has a floating interest rate which changes based on the amount of liquidity available in this asset pool. If the liquidity is high, then the interest rate is low. When a user wants to borrow funds from Compound Finance, the Compound Finance protocol enforces a rule that each account has to have a balance that covers the amount of borrowed funds. This rule is known as the collateral ratio, and a user cannot initiate action, for example borrowing or withdrawing assets that would bring a user's account value below the collateral ratio. Interest rates. The current lending and borrowing rates can be found on the Compound Finance platform. Many of the assets that you can borrow or lend have a floating interest rate, and that changes on the amount of liquidity available to borrow. Why is the supply rate lower than the borrow rate? This is because in each liquidity pool there needs to be an excess of funds. Assets supplied needs to be higher than the amount of assets that are borrowed, and this allows the users to quickly withdraw or borrow funds from the protocol without having to wait for enough liquidity. And the interest rate that is paid by borrowers is earned by the suppliers of assets. And that is why you don't earn the same amount of interest on your funds that someone has to pay to borrow funds from the Compound Finance protocol. Furthermore, 1/10 or 1/20 of the interest rate, based on which market, that is paid by borrowers is added to the reserve pool. And this pool is a liquidity. It's a type of safety mechanism to make sure that there's enough liquidity in the market. Liquidation. Not a very good word to hear, especially when you want to borrow assets. This is the definition of liquidation based on the Compound Finance website. If the aggregate value of your outstanding borrowing is greater than your borrow limit, your account will be liquidated. Compound has an account service API that developers can use to track the health of different contracts on the Compound Finance platform. On this dashboard, you can see the address, the amount of assets supplied, the amount of assets borrowed. The health column shows the status of the account. An account that has a health below 1 can be liquidated. The supported assets on Compound Finance version 2 include Ether wrapped Bitcoin, which is an ERC20 token backed one by one with Bitcoin. You've got DAI. You've got Coinbase US dollar coin USDC, Augur Reputation Rep, Xerx token, and basic attention token. What are cTokens? When you supply digital currencies to the Compound Finance protocol, you get cTokens back. All assets supplied to the compound finance markets are represented by an ERC20 token called a cToken. The longer you hold the cToken like cDAI, the more DAI Ethereum you can withdraw than you initially supplied if the price of Ethereum stays the same. The longer you hold cDAI, the more interest accrues over time. And this makes earning interest as simple as holding an ERC20 token. This increases the amount of use cases that you can have with these type of cTokens and a compound finance protocol. That brings us to our next chapter, use cases. cTokens, the ones that we just looked at, which earn interest when you keep these tokens, are being used in many different popular DeFi projects such as a set protocol, automated ERC20 trading strategy, you've got Dharma, DeFi Zap, Pool Together, no loss lottery system. In a nutshell, cTokens allow for passive income to be earned when holding a stablecoin. Instead of holding DAI or USDC, you can hold cDAI and cUSDC. The last question you might have is compound finance safe? So even though Compound has undergone a number of security audits by reputable agencies like Open Zeppelin and Trail of Bits, all of which have been publicly disclosed, you do not really know what can happen. There could be a hack, there could be a smart contract bug and so on, which depletes the whole liquidity of the compound finance protocol. You have to be aware of these type of risks. I think it's a fantastic dApp to use if you want to earn some interest on money that you have lying around. And yeah, the amount of interest that you can earn is around 8% at the moment, but it can go much higher. It can also go a little bit lower. But it's a lot better than the amount of interest you can earn if you just keep your money in a bank. And in my opinion, it's a lot safer than keeping your money in a bank, depending on which country you're living in. Thanks a lot for watching. I hope you found some value in this video. I'm really pumped about the whole decentralized finance space, as you might have realized. And I'm also very happy that Compound Finance platform is working out so well for me. And I also hope that you can also start maybe investing and trying it out for yourself. If you've got any questions on how to do it, you can leave it down in the comments below. I will gladly answer all these questions. There's a lot happening in the space. It's growing at a super exponential fast rate. And yeah, I'm really excited about that. So I'll catch you in the next one. Have a good one. Bye-bye.